Well, another hotter than expected inflation report raising questions about when the Fed will cut rates, while consumer inflation expectations for the year ahead inched higher. Here to assess the best investing plays amid a roller coaster week for markets, let's bring in Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Luis, good to talk to you today. So on the one hand, we got two inflation prints this week that seem to suggest that things are not necessarily moving in the right direction or moving along as smoothly as we would like. And yet consumer sentiment up for 3 straight months. We are at a high we haven't seen in more than 2 years. How do you weigh these two?
Yeah, there's definitely some type of lag over there in the data, right? What we get from consumers is that they still feel that the job market is improving, that's still good, and inflation will eventually come down as well, right? So the CPI and PPI being kind of lagging indicators, not confirming that. However, we do believe that the expectation moving forward over the next few months is that we're going to start to see inflation come down. So the question is going to be, was this just a bump on the road, or are we really going to see some inflationary pressures pick up? In that sense, that would bring us to a tailspin, because it's a tail risk that consumers or investors are not really considering right now.
How do you see it, Luis? I mean, was this the bump that was expected in the eventual end of the road, which is the beginning of the rate cutting cycle, or is this a sign that things are not necessarily moving in the right direction?
Yeah, the way that we view it is that this essentially could be a bump on the road. We're still expecting some sort of slowdown over the next 3 to 4 months, pretty much the first half of the year, and then an eventual recovery. But to Chair Powell's point, when he took March out of the table, it was still too soon to start pricing sort of the aggressive rate cuts that the market started pricing since late December, right? So they got ahead of themselves. The Fed doesn't want to make the same mistake that they made in the 70s, in that they cut rates too soon, too fast perhaps, and the economy is still chugging along. So I think the Fed is going to be cautious. On our expectations, we still believe that most likely 3 rate cuts is what the Fed is going to give us in 2024. We pushed out the data a little bit further, probably May, even though probabilities are declining, it could be June. You get mixed up a little bit with the Fed balance sheet and what they're going to do on tapering. So I would say it's still vulnerable, right? On the other hand, the other tail risk that other market pricing or other market participants are not pricing is that if inflation stays sticky, right, the Fed could bring back again another rate hike, right, which is pretty much not really talked about right now.
It's been a choppy week in treasuries. When you look at where things are right now, the 10-year, right, just below that 4.3% level. I mean, what's your expectation moving forward? Is it going to push higher, above 4.5%, or are we kind of in that spot that we're expected to be, despite shifting expectations of when that rate cut will begin?
Yeah, yields are very reactionary, and you're going to continue to see yield reaction as we continue to get more data, incoming economic data over the next few months. The reactions we saw today is pretty normal, I would say, just in the sense that rate cuts are being priced to be pushed out. When you look at fundamentals, for example, on the 10-year yield that you were mentioning, we could do a quick, simple math, right? You look at inflation expectations over the next 10 years, probably around 220. You think that the Fed is going to probably want to keep real rates at about 2%. If you just do that simple math, that brings you around 420. Add a little bit of a term premium, and you can hike a little bit higher or perhaps a little lower. But another thing in the mix that hasn't been kind of thrown out there is obviously all the situation with the fiscal deficit of the U.S., the amount of Treasury issuance that we can continue to see as 2024 continues to progress, and that could continue to add pressure to yields. So we're still believing the tale of two halves. The first half of the year, we could perhaps see yields move lower as the consumer slows down a little bit and inflation gives way, allowing the Fed to do some rate cuts. But then towards the end of the year, we expect that recovery. And at that point, we expect kind of yields to move back up higher because the economy will continue to grow at a better momentum. And also because perhaps we still have kind of the lingering risk of the amount of government debt, the amount of deficit, and the amount of Treasury issuance.
Mm-hmm. So, Luis, how are you advising clients? I mean, do you go for corporate debt? Do you go into treasuries, maybe on the longer end of the curve? Where do you position yourself?
Yeah, we're not really advising clients to take a pretty brave stance on the long end of the curve. Pretty much when we saw the swing back on yields at the end of 2023, we removed our long duration call. We're more neutral duration, neutral long term. We think investors should be positioned all across the curve. Obviously, the most attractive place right now is short-term fixed income, and we consider short-term fixed income anywhere between 1 to 3 years. If you have investors that have been over allocated with excess cash, cash holdings, money market funds, 3-month T-bills, it could be a good opportunity to lock in and move a little bit out of that ultra short into that short-term fixed income, especially if we believe that the Fed is going to cut rates in 2024, which is still our base case, right? So from a positioning perspective, I would say follow your objectives. Short is the most attractive, but there's definitely opportunities to be done in that belly of the curve, that intermediate. And then you mentioned investment-grade corporates. Yes, that is a good sector that we like as well. We don't think investors are really pricing in any sort of like risk in the credit markets. If you look at credit spreads, they are close to all-time lows. So investors are not really pricing any credit risk at the moment. The maturity walls that could be a threat to investment-grade corporates or high-yield corporates even seems to be a little bit far out still in the calendar. So no real pressure seen there. It's a good opportunity to collect the income, right? Lock in attractive yields, and then investors will be able to enjoy that income.
Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Appreciate you stopping by today.